Record high inflation and the growing hawkish tones of global central banks, including the Reserve Bank of India, has derailed recovery in the equity markets. The benchmark Sensex, for instance, had jumped about 15% from its March lows to hit a high of 60,612 on April 4. However, the RBI's hawkish policy, along with the US Fed chairman's hint at a 50 bps rate hike in May, weakened the bulls. Besides, persistent geopolitical tensions and lower than expected Q4 result of India Inc. so far also dented the sentiment. Consequently, the benchmarks fell about 6% from their April highs and ended the previous month with a loss of 2.5% on a month-on-month basis. Now, as we head in May, the old adage of sell in May and go away is unsettling investors. To be sure, this saying has often proved true for the US and European markets. Data since 2010 shows Indian frontline indices have given positive returns on 7 occasions in the month of May. Last year, Nifty 50 and S&P BSE Sensex rose 6.5% each during the period as global central banks continued with their dovish stance. However, the May of 2022 may be different. Global central banks are withdrawing liquidity and China is seeing its worst COVID outbreak yet. Analysts believe that if China, known as the factory of the world, continues with its zero COVID policy, it will aggravate global supply chain disruptions further.
Presently, the markets have turned excessively volatile, particularly in the mother market, the US. This excessive volatility is likely to continue in this May also. In the US, a 2% up move in one day, followed by a 2% down move in the next day, and then again a 2% up move in the third day. This kind of volatility has become very commonplace now. This excessive volatility is because there are some very strong headwinds and equally strong tailwinds for the market. The major headwind for the market is the expected aggressive tightening, monetary tightening by the Fed, expected in 2022 and even beyond. This context of monetary tightening is not conducive for a bull run in the equity markets, particularly when global growth is weakening. Therefore, investors are not advised to buy aggressively in this volatile market because the volatility will continue. There can be sharp downswings in the market. So it would be ideal to move some money into cash and wait for sharp downturns in the market. And sharp downturns can be used to buy high quality stocks in a calibrated manner.
Back home, indicators aren't favoring the bulls as well. Resurgence of COVID-19 and rising inflation are the immediate threats. While India's biggest initial public offer of LIC may bring short-term respite for investors, analysts caution that markets cannot be immune to the pain seen in global markets.
Markets may follow the adage of sell in May and go away, as I believe the LIC IPO could act as a catalyst for the same. Though the drain of liquidity is much less than earlier envisaged, still 21,000 crores will have an effect. The earnings season too is not very encouraging. This, along with the rate hikes, which could be as high as about 50 bips, will ensure that the mood on the street is somber. It's advisable to remain liquid to an extent to utilize the opportunities at lower levels.
Against this backdrop, technical charts indicate that the Sensex could move in a broad range of 54,500 to 60,500. Investors can expect significant support around 50,650 odd levels and resistance around 59,350. Nifty 50 is expected to move in the range of 16,200 to 18,300 with a support at 16,000 levels and resistance at 17,550. Meanwhile, investors will track Q4 report card of HDFC, Britannia Industries, Tata Consumer, Inox Leisure, Hero MotoCorp, Tata Steel, Titan Company and Tata Power in the holiday truncated week. They will also wait the launch of LIC's mega IPO due on Wednesday. Globally, US Federal Reserve and Bank of England will announce their interest rate decisions.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.